Hey folks, we're going to continue our talk on job order costing with explanation of how the overhead T account works. So this is probably one of the most important topics in all of managerial accounting because overhead represents lots of dollars and you need to understand how they flow in and out of that T account. So the manufacturing T account, the very first thing I do always is when I draw an overhead T account, I make a note to myself that all of the debits are going to represent actual cost, all of the credits are going to represent applied costs. So examples of actual overhead cost would be indirect materials, indirect labor, and then any cost whatsoever that deals with the factory, such as depreciation, property taxes, insurance, supervisory salaries, utilities. Actually, the supervisory salaries would really be indirect labor, but you get the drift. If it has to do with the factory, it belongs in overhead. Okay, and then the credits represent the applied overhead, and the formula for getting that is to take the predetermined overhead rate times the actual activity. So I guess your next question is, what the heck is predetermined overhead rate? All right, it is a rate that's determined before you ever do any work during the year. And you make an estimate of how much overhead actual dollars you think you're going to spend during the year, and you're going to divide it by the estimated overhead base, which is your activity level for the year. So that could be direct labor dollars, direct labor hours, machine hours, flight hours, number of beds in a hospital. Could be anything you want it to be. Number of guests, number of customers. Whatever causes you to spend the overhead dollars is going to be your base. So in our example that we'll continue here in a second is we're going to assume that the base is machine hours, and our predetermined overhead rate is going to be, we think we're going to spend $600,000 during the year, and we think we're going to incur 100,000 machine hours during the year. So our rate is going to be $6 per machine hour. So if we go back to our journal entries and we assume that we worked 8,000 machine hours, then what I'm going to do is I'm going to debit work in process, credit overhead for the 8,000 machine hours times $6 per machine hour for $48,000. Okay, so if I go in now and I post the actual overhead dollars that I put into my overhead account, and I credit the applied overhead, I'm going to end up with a debit balance in my overhead T account of $2,500 at the end of August. So I don't want that balance in there. I want to zero it out at the end of the year. If it's a debit balance, it's called underapplied overhead. If it had been a credit balance, it would have been called overapplied overhead. All right, so since we have a debit, what we want to do is we want to close out the underapplied overhead at the end of the year. So I'm going to go ahead and do these journal entries right now. We're going to close the underapplied overhead. In managerial accounting, the principles class, we keep it simple and close it just to cost of goods sold. If you're an accounting major and you're going to do it for cost accounting, you apply it to the work in process, finished goods, and cost of goods sold, where your inventories are sitting. So we're just going to keep it simple right now and do cost of goods sold. The objective is to get a zero balance in the overhead account. So because we have a debit balance in overhead, I need to credit overhead. So that tells me I'm going to debit cost of goods sold. So guess what? Cost of goods sold has a debit balance normally. So the overhead account is going to increase my cost of goods sold, which will decrease the gross profit or net income for the company as a whole. So keep that in mind. And let me go ahead and finish out the journal entries from the first video. So we've applied our overhead. Let's transfer some goods from work in process to finished goods. And let's make a sale on account, a big sale or several sales all at once. And we want to also take the cost of what we sold out of finished goods and put it into cost of goods sold. Okay, so now we are ready to show you the computation of cost of goods manufactured, cost of goods sold, and we'll finish it up with a basic income statement. Okay, I'll see you back in just a few minutes. Bye.